Many founders still think that finance is talking about or taking care of bookkeeping and compliance. When does finance become a true strategic advantage?
And that's I kind of touched on that in the last question. I think traditionally, as you mentioned, finance and accounting, right? It's okay. It's just getting my books together, right? And that's really what's already happened, right? But what you can utilize, and don't get me wrong, like you need that accounting and bookkeeping structure in place to do the forward looking. But what you can take from that data, right, is you start looking at metrics. And specifically, they're going to be industry metrics, right? If we're in the SaaS,
Okay, most founders believe that building a great product and growing revenue is enough to build a valuable company. But when investors, lenders, acquirers show up, they often discover that financial infrastructure matters just as much as innovation. Erin Ludwig has spent nearly 2 decades helping companies build that foundation. From Big Four accounting at PwC to leading financial functions and are now a co-founding member of the Bluebird Partners, she has been helping founder-led private equity-backed technologies companies prepare not just how to grow, but to achieve premium exit. As a CPA and a fractional CFO, Erin works with SaaS businesses in 5 million to 50 million ARR range, helping founders build board ready reporting, improve financial visibility, raise capital, navigate acquisitions, and maximize company value. Today, we are going to talk about financial leadership, scaling SaaS companies, preparing for exit, private equity expectation, and why finance should become a strategic advantage, not just a reporting function. Welcome to the show, Erin.
thank you very much. Thanks for having me.
Okay, so the journey to becoming a fractional CFO. You spent nearly 2 decades. That is a lot of time in finance before launching Bluebird Partners. What made you take the leap from corporate leadership to entrepreneurship, Erin?
I believe it was a little bit of uh, I came, sorry, I'm a little nervous, so I will start over again.
Yeah.
So yeah, so I think a lot of it was a point in my career where I had got up corporate. I saw what it was. It wasn't really something I was that interested in, but I really wanted to grow my career, and I saw that there was this huge gap in the lower middle market area that needed this expertise. And
Mhm.
that's why I took the leap. I've always been a little bit interested in entrepreneurship and how to grow something. And I met my partner at the time and we kind of were talking and we decided to start this business.
Mhm. Great. So looking back at your time at PwC and the companies that you worked afterwards, what experiences shaped the way you advise founders today?
I, I think I was able to get a really good infrastructure and understanding of how accounting and finance works and how at very big levels from an operational standpoint the accounting
Mhm.
function is set up, and I'm able to take that and apply it to these smaller type companies, and knowing the lens of as you scale, this is how we can implement this structure.
Okay, got it. And what attracted you specifically to working with founders-led technologies companies?
I really like the space. It's a high speed space. It's an industry where there tends to be a lot of transactions, and founders tend to come in with the thought process of, I'm going to sell fairly quickly. So I like to be involved in that kind of atmosphere and environment. So that seemed like a perfect fit. Also, my partner comes from a big technology background and he's very familiar with the industry. So blending those two things together, it just made sense for us to go down that route.
Makes sense, makes sense. Now let's talk about building Bluebird Partners. Uh, you did talk about how you met your founder and co-founder, and how and why did you start this business. What gap in the market did you see that convinced that there is a need for a firm like Bluebird Partners?
So there's a lot of these companies that are coming into capital or about to have some kind of transaction, and they really have no financial infrastructure put in place, or even, maybe even not even a someone above a bookkeeper level, right? And when you start going towards these more institutionally invested type funding or acquisitions, you really get scrutinized during that financial infrastructure uh, and looked at really closely. And if you don't have that, it can have a negative impact on your value and on your exit and how much you're going to get from it, and you're going to start getting discounted. So the idea was, hey, we can come in and we can help these companies prepare for that so they're not getting negatively dinged for not having those things in place. And we really
Mhm.
didn't see anyone in the marketplace specifically focusing in this area. So we felt it was something that we could come in, bring our expertise, and help a lot of companies in that area.
So, Erin, Bluebird focuses specifically on private equity backed and founder owned technologies company. Why did you decide to specialize instead of serving every type of businesses?
I mean, at the end of the day, you can only get good at a few things. We decided to take where our experience was and really know that industry very well. So when a company comes to us, they're getting a, the premium expertise in that area. Like, we know exactly what metrics are being looked at from an evaluation standpoint. What do you need to track to ensure that you're getting the highest enterprise value? So things of that nature. We just felt that us putting our skill set to where we know we can provide the most value for these companies.
Yeah, so that was going to be my next question
Yeah.
about premium exit.
Yeah.
Your website talks about building the financial infrastructure for premium exit. What does that actually looks like in practice, and why should founders start thinking about it much earlier than they usually do?
So that really comes down to having clean metrics, having a coherent financial model that you can pressure test situations. That means having lender compliance metrics that you're using to ensure that you are compliant with your lender standards. That means having clean cap tables. It's all those things that go into when a company is being evaluated for a sale, and ultimately the exit price, right? That they're going to take all those things in consideration. And if you don't have that in place, things start getting discounted and pulled back. So it's not necessarily it's increasing the value, but you can get knocked back in the value by not having that in place. And those aren't things that you can put in place in a relatively short period of time. Like,
Mhm.
it's processes, and the more time you have to build those and really get a bulletproof financial infrastructure in place, when you decide to go through we decide to go through a transaction like that, you are it's a much cleaner process, and you don't start getting like questions and people losing credibility in what you're saying and the picture that you're presenting.
So, Erin, when tech-led startup founders should start thinking about getting a fractional CFO in, what is the right time? What level of revenue, ARR, MRR, when?
Yeah, I mean that really depends, but I would say as you're approaching that $5 million in ARR is when you should consider to start to think about it. I say that there's uh, a few different pivot points that may be a good point of like, okay, this makes sense of bringing a fractional CFO in. One is if you've come into some kind of financing, so you have some kind of cash, right? And now you have some investors that are looking at you and asking questions and want to know how you're going to deploy that cash, right? So that's a forward-looking thing. That's something that we build into our process is, okay, let's build a 13-week cash flow. Let's know where your cash is going, how much runway we have. Another thing is you're truly trying to scale, right? Having
Mhm.
that, having a financial structure in place that helps you look at trends and where things are going and how things have happened, and then how are we going to use that information to help make decisions going forward, right? And those decisions going forward of like, how am I going to scale my company? How are we going to grow? What's the hiring plan going to look like? So I would say that's another inflection point. And then the last one would be, which we've kind of touched on a lot here, is some kind of transaction, right? You're going to have to go through some kind of due diligence process where your financial infrastructure is really going to get scrutinized.
Understood. So, in this segment, we are going to talk about finance that creates enterprise value. So, Erin, I speak with a lot of founders through various medium with my angel group that I run and through Rich Entrepreneurs Club that we have and whatnot. Many founders still think that finance is talking about or taking care of bookkeeping and compliance. When does finance become a true strategic advantage?
And that's I kind of touched on that in the last question. I think traditionally, as you mentioned, finance and accounting, right? It's okay. It's just getting my books together, right? And that's really what's already happened, right? But what you can utilize, and don't get me wrong, like you need that accounting and bookkeeping structure in place to do the forward looking. But what you can take from that data, right, is you start looking at metrics. And specifically, they're going to be industry metrics, right? If we're in the SaaS, it's going to be, you know, your CAC ratio and your ARR, your NRR, numbers like that. And then um, also looking at trends, right? And then from that data, you then can build out and make goals for the future or see where there's potentially problems, right? So if all of a sudden our ARR metrics are keep going up, and then all of a sudden it flattens, right? Okay, well, now that's requiring us to go look back in the business and say what changed and why did it change and what do we need to do to make it keep going up or whatever our goals might be. Another one might be an example of uh, gross profit, right? Is like, okay, I'm always trying to balance how much my uh, cost is of delivery versus like the cost of the the subscription or whatever it might be that I'm charging, right? And I'm going to keep trying to drive that number. And when I see that there's a blip in there, okay, what happened? Okay, well, oh man, maybe we hire too quickly, too fast, and we need to balance this out. Or it also gives you the wherewithal of I want to hire, but is now the right time to hire, right? Like, so I know I want to keep my margins at this, and I if my revenue is not here and I'm going to push in a bunch of new hires at this stage, that might be not the right time, and I may need to push that out over multiple months. So it really is when you want to move more away of just looking at what happened and how can I strategically look forward in the business. And that's where I think the click is the difference between the true like accounting finance function versus doing strategic CFO work.
Mhm. Understood. So, tell me some stories. If you walk into a company for the first time, what are the biggest financial red flags that you typically see?
I think number one is cash visibility, right? I think a lot of times I have no idea where my cash is, what's coming up, what's going out the door. If this client's going to pay me on time, I don't even, really know like the terms that I'm like working with here, right? And how your inflows and outflows fit into that puzzle, right? Like, so you might think like, okay, one off, I know this should come in here, but then I know I have to make a payment sometimes around here. But unless you lay that out in a forecast, it's hard to see it, right? And really what the idea of a 13-week forecast is, cash forecast, is really making sure you don't have surprises, right? It's knowing what's going to come in and what's going to come out, and you're updating that weekly. So with more information, it's going to adjust, and it's helping you identify if I might have short gaps. I know of it well in advance, and I can set up solutions to help me through those things. If that means, I got to set up or increase my line of credit or whatever that might be, but you have time versus I wake up in the morning and I don't have time anymore. I think the other thing, especially in the technology industry, specifically maybe SaaS, is really knowing your metrics, knowing your metrics on how that type of industry is getting evaluated, right? So if that's revenue metrics, if that's your EBITDA numbers, like how does the industry, when people are looking at the industry at the whole, how do they say if your company is doing well or not? I think knowing those things, then you can work to get to at least what industry average is, and then work to be better than industry average. But if you don't know those, it's hard to work towards those things. I think the last one, I would say, this kind of goes a little bit with, this is like a blend of both of those, is kind of really knowing your burn multiplier. So that's just basically saying how much cash you're spending divided by how much net annual revenue you have coming in, right? So am I burning cash more than I'm collecting revenue, right? You always want to have a touch point on that thing.
Okay, great. One fun question. A founder should lease a car or buy the car in the name of the company?
Sorry, say that. Sorry, I missed it. The company should
Lease
what?
a car or buy the car for the
So yeah,
company?
right. So again, you really have to know what the objective is of the company, right? Like in that scenario, one answer is not the right answer, right? What might be right for one company might not be right for another company. So one company, it might make sense. Okay, hey, we're sitting on some cash. We're having a fairly profitable year. We do need a vehicle, and it's, let's say it's close to year end. All right, yeah, let's maybe make this purchase, and we can get a tax write-off basically of your entire vehicle, right? Okay, so that might be an approach for one company. Another company that is, let's say a little bit tighter on cash, right? They're potentially not as profitable in this current year. Okay, well, maybe leasing and spreading that payment out over the course of the lease makes more sense. They don't really need a huge tax deduction this year. They're getting, they're getting to write off the entire lease payment that they're making, versus in a purchase situation, you're only getting to minus that first year that you get to write off the vehicle for, special depreciation. You're really only getting to expense the interest piece. So it's really, you really got to know what circumstances you're in, and like those are decisions that I would say that's what a fractional CFO is supposed to help with, right? It's okay. Let's look at the scenario here. Let's look at all the information we have, and now let's look at the pluses and minuses of both, and what makes the most sense to do right now, right? And again, that decision may be different today than it would be in 3 years from now, right? Maybe the tax legislation has changed. So, who knows what it is, right?
Yeah, right. Great. Thank you. Thank you for that answer. So now we are going to talk about fundraising, private equity, and exits.
Okay.
So, Erin, the first question on that is, yeah, you have obviously worked with both founder-owned businesses and the PE-backed firms. What do investors expect in founders that founders often overlook from the financial statement standpoint?
I really think they want to feel very confident in the financial story that you're telling, right?
Mhm.
They they want you to give packets or decks or books that they can ask questions about and you can answer them with confidence and backup behind why these numbers are these numbers and what's the trend looking like and why is the trend looking like that. That they're also going to expect that if you put a deck together and on one page you have an ARR number that's this listed here, and then on another, you know, page in there, it's listed something else, and there might be a reason for that, but you need to be upfront and explain. Okay, well, from this angle, we're looking at ARR in this way. In this angle, we're looking at it this way. We've backed out this number, so they have a clear understanding of how you're looking at the business. And if you can tell that story with confidence, it gives them a lot of confidence in that you
Right.
have that kind of financial infrastructure put in place.
Mhm. Great. What separate companies that receive premium valuation from those that struggle during fundraiser or acquisition?
Yeah, I kind of touched on this a little bit earlier. I
Mhm.
think the one thing is really knowing the metrics of your industry, right? So it's it's looking and saying, okay, I need to know the benchmarks of the industry that I'm in, and I want to make sure that my benchmarks are at least, you know, what is expected, if not better, right? I mean, that's going to get you a higher just evaluation in general, just enterprise value. But the other thing I touched on is that credibility and confidence in telling your financial story.
Mhm.
Those things don't necessarily increase your enterprise value in the sense of the initial evaluation, but they are going to make sure that you're not being discounted on that original value, right? So a lot of times you see private, smaller SaaS companies get discounted almost 20 to 30% just based on the financial story that they're telling and the credibility that they've given to
Right.
investors, right? Versus companies that are a little bit larger and they have that infrastructure built out, even though the revenue numbers might potentially be the same.
Mhm. Understood. If a founder plans to sell his company in 3 years from now, what should they start doing today?
I think it's kind of reiterating back of a few things that I've already mentioned. I think you really want to have that lens of is my company in this industry being evaluated, right? And I should start tracking those things, right? So number one is, okay, I got to start tracking, right? I'm not going to know where I am if I don't track, right? And when I start tracking those, those different metrics and looking at them in detail, then I can start saying, okay, where am I? Where am I to where a lot of peers in my industry are, right? And then it's taking it one step further of, okay, I'm here and maybe I want to be up here, right? And now how do I get there, right? And a lot of times, like I always say, financials and financial modeling, right? It's taking past information and then applying, a lens of how I can apply this to the future. But a lot of times it's things within the operation that need to change, right? And it's giving you that lens of like, okay, I need to improve gross profit. Okay, now it's saying, what are the levers that go into gross profit, right? Okay, well, I only have a few levers that go into gross profit. Usually kind of the companies that I'm working with, it's, revenue, right? However that revenue is generated, right? And then there's cost of goods or cost of services. In most of the case, people delivery is the highest cost, right? You might have some technology costs in there, right? And those are pretty much the only metric or the only inputs that you have, right? That are going into gross profit. So now it's looking at those and say, how can I change those to improve gross profits? Revenue side, it's like, okay, well, how am I doing my billing? Like, can I increase pricing? Can I, do I need to look at different my different revenue streams? Okay, maybe this one revenue stream is not profitable anymore, right? And looking at it from that angle, and then you look at it from a a cost standpoint. It's okay. Do I have too much headcount? Do I have not enough headcount? Do I have the right people in the right spots on delivery? What is my technology spend looking like? Can I put a little bit more guardrails around that, right? And then you start looking at those pieces, and then ultimately that can help you improve your gross profit if that's what you're getting at. And it might take like, okay, first I'm going to focus on this lever. Okay, I think I got everything out of this lever. And now I'm going to go over to this next lever. How can I improve that lever, right? So it's, it's really looking at those metrics against your peer companies and how can I improve them.
Understood. So many of our listeners are founders.
Yeah.
So give some advice to founders. If the founder could only focus on 3 financial metrics every week, what would you recommend?
Especially in the industry that I'm in, I would say, really knowing your like revenue numbers, right, daily. And I would say most companies that have a high volume, right, they should be looking at their revenue numbers on a weekly basis. The other one is cash. Like, I mean, this is regardless of what industry you're in. You really need to know your cash runway. You need to know what's coming up, what's going to go out, what's going to come in, and really plan that out accordingly. And then I think the next one is, I also touched on it, is just weekly. I think it's a good idea to kind of get an idea of taking those two numbers and comparing them, right? Like, look, okay, well, how much cash is going out the door and how much revenue am I bringing in? And am I still working in a profitable range, right? And even if it's like, okay, one week I'm not quote unquote profitable, but I know I'm getting a catch up here. It's just kind of having a touch point on that number.
So just to summarize, your revenue number on a weekly basis, comparing your revenue number to your last week number or last month number.
Yeah, whatever that might be. Yeah.
Yeah, and also looking at the cash position in the company. How
Yes.
much cash is there? Cash is king. So you need to look at that.
Yeah. I would say if there was one thing that I would pick, it would say, look at that.
Understood. What is one financial mistake you see founders repeat over and over again?
I would say the biggest thing that I think is sometimes hard for founders to like wrap their head around, especially when they're going through some kind of fundraising or acquisition, is the confusion of cash and profit. I think you need to look at them separately, and they're equally as important, right? I think a lot of times people will say, well, I have no cash, but I'm profit. But I have a profit. Why is that, right? And vice versa. Like I have cash, but why am I sitting in a negative number? I think you just need to know that there's timing differences and there's different things that are only cash transactions and they don't hit the P&L, and you have to treat them as almost separate metrics, right? Like I
Mhm.
say, okay, yes, from a P&L standpoint, that is going to be a lot, that's going to be very heavily weighted on when you're going for enterprise value and, um, fundraising, and that's going to get scrutinized a lot. Cash day to day, that is probably what you need to be managing on a day to day basis, right? Because if you don't have cash, you're probably not going to have a business either, right?
Right, right. Yeah, sure. If you could leave entrepreneurs with one piece of advice about building a company that attracts to investor and acquirers, what that would be?
Um, I think a lot of it is have this thought process that this stuff is important early, right? It's really hard to say, okay, hey, we're going to build a financial infrastructure, and you're like, I want to sell in 60 days, right? There's only so much you can do, right? So I think if you start thinking about this early on, it takes time, and like any type of process, you reiterate and you get better and you get better and you get better, right? And it's only going to be so great if you decide to say, okay, well, now is important because I have this imminent transaction that's happening and it's only, 6 months away. Where it's like, if I thought about this 3 to 5 years ago, we can have a really good dialed in process. And it's a process that has matured with the company, right? So
Mhm.
as you scale, like every part of your business is going to have to be modified, right? And with that is also that financial infrastructure piece. But you now don't have to do it in one full swoop. You do it in little increment changes along the way. And so I think the biggest thing is having that mindset early and putting the right people in place and start thinking about it. And I know sometimes with founders that's going to be difficult because yeah, at the very beginning it's like product, service, what am I delivering? Like that is the most important thing, right? And yes, that is, ultimately you need that and that is the most important thing. But as you've kind of gotten some traction there, is start thinking about the operation side of things
Mhm.
and how that as you mature and you scale, those things become just as important as product.
Sure, sure. So, as a fractional CFO, and we are now living in the world of AI, how do you see the CFO role evolving as AI and automation become part of every business every day?
Yeah, it's a pretty interesting time. I've had a little bit of experience with it. For me, I would say in our profession, it's really helped on the back end office type stuff. So like
Mhm.
the crunching of the numbers, the putting together the basis of financial models, able to take mass amounts of data and review trends very quickly. The thing I don't think it's replacing is the judgment of what we do with those outputs, right? So it's okay, we still need humans that have experience and also the relationship with the client and understanding the client and having all that context to say, okay, great, we have this wonderful output that took us a lot less time to do, and now we can actually spend more time on the things that really matter of the strategic decision making. So I would say that that is um, i- in my world as of now, it is actually a very exciting time because I feel like it is lending us to actually provide the higher level services now
Mhm.
than spending a lot of time on the back end things, right? That from a client perspective, right? That's not that much value add, right? It's just, okay, you need to do this to provide the value add.
Mhm. Mhm. So, beyond financial, what qualities do you think a founder must have so that they are loved by the investors and future acquirers?
Um, I would say the qualities are you need to be nimble. Um, You need to have a growth-minded like lens to view things. You're gonna be put in a lot of situations that are brand new to you, and you hopefully will surround yourself with experts and people that have a lot of experience, and take what they're telling you and take that information, right? And try to learn a little bit about everything, because it's going to make you a well-rounded founder. It's going to make you, at least from, on my side of things, right? Like we always like to coach the founders a bit, because a lot of times they're going to be in rooms with investors without us, or they're going to get a phone call, right? And we want to give you enough tools that you probably can answer some basic questions about your deck, right? And I think that that's like a really important skill. Like you don't want to fight those fight learning kind of the new things that might be out of your domain. At least be open minded to it and gain enough knowledge that it can just make you really well rounded, that you can go speak to investors about a lot of different things. And they're like, oh, wow, this founder really knows a lot about business, but they also know a lot. I mean, but they also are extremely passionate about the thing that they developed.
Mhm, mhm. Sounds good. After helping so many companies grow, what does success mean to you today, Erin?
For me, I get a lot of value out of kind of the thing I just touched on is being part of a growing company that's usually a founder-led company, right? And watching them grow and being a part of that team and giving them and the team additional tools to do that, right?
Right.
And seeing them be able to unlock new things, right? And that's really what drives me. Like I think ultimately at the end of the day, I love coaching and teaching, and I just happen to do it from a financial lens, right? But um, the thought, like when I get to see someone really develop and grow into something that they weren't before, like that gives me a lot of like passion, and I get to drive a lot of value from that.
Great. Thank you so much, Erin, for your time today on my podcast. Really uh, a pleasure talking to you. Growth mindset, cash is king, know your numbers. We discussed about all those things. So thank you so much once again for coming to my podcast.
Yeah, no, I really appreciate it. This was a really good time. Thanks so
Yeah.
much.